Buying your first home is one of the biggest financial decisions you'll ever make. And if you're like most people, nobody ever taught you how to actually do it. You've got 100 questions, you're getting 100 different answers from Google, TikTok, all the LLMs, your parents, and from that one friend who bought a house 3 years ago and now he thinks or she thinks they're an expert. It's actually quite overwhelming. I've helped hundreds of first-time homebuyers get into their first homes. I've worked on every side of a real estate deal. As a realtor, mortgage, and insurance. I've actually seen what goes right, what goes wrong, what separates the good from the bad, who gets the keys from who gives up. So in this video, I'm gonna walk you through the entire home buying process from start to finish. Everything you need to know in order, step by step, from figuring out if you're actually ready, all the way to getting your keys and moving in. By the end of this, you're going to understand exactly how this works. No more guessing, no more Googling at 2 a.m., no more conflicting advice. Just a complete picture from someone who's been through this process hundreds of times. Before we talk about anything else, we need to figure out if you're actually ready to buy. And I don't mean emotionally ready, I mean financially ready. Because I've seen too many people fall in love with a house they can't actually afford. And that's a painful, dreadful experience I want to help you avoid. All right, first let's talk about your credit score. What is good enough and what gets you a better rate, and also how to improve it really fast if needed. So here's a big myth. Most people think that you need, a high 700 credit score. It's just not true. As a matter of fact, FHA, we can go down to as low as a 580 credit score, and in some cases even lower. That gets you in the house. And an FHA rate is actually typically a lot better than a conventional rate, with some other nuances that we'll talk about later. But do not be fear-mongered into thinking that you can't get there with a lower score. The truth is, though, with a better score, you will get a better interest rate. And so that's something really important to figure out. Depending on the loan type, there's tiers and bands of credit scores that get you a better interest rate. Now, oftentimes, and now is actually one of them at the time of filming this video, that a lot of lenders will actually remove what we call overlays on different credit bands. So for example, if you have a credit score in the range of 580 to 599 or 620, that'll have some hit, which means you get some reduction against you, which brings you at a higher rate because you have that credit score. Oftentimes, lenders will actually eliminate those to balance the playing field to where the lower score gets you a very similar rate as to a score maybe 100 points higher. Something to be mindful of, and those are market driven, they change all the time, but it's not always necessary to have that higher score. So the best thing to do is to check with the lender up front and just kind of see where you stand, and then you can know what your options are and see what you're comfortable with. Next, if you do have a score that doesn't qualify, or let's say you really want to be in a conventional loan, you might do something called credit repair. And the way that works is you typically hire a credit repair specialist, and they will go in there and chop through all the noise and the mess, and they'll actually teach you and show you how to improve your credit score. A lot of times they're doing things like basically paying off credit cards where you can have a lower utilization. A lot of people think that 30% is the rule. So let's say you have a $1,000 credit card limit and you want to keep your used amount at $300 or less. That gives you a 30% utilization, and that's very good. But what's even better is a single digit utilization. So in that same example, rather than a $300 balance on your card, you want to have a single digit utilization, which is at $100 or less, giving you the biggest boost of a credit score, optimizing your chances to get the best rate. There's other things they can do, like remove disputes and write letters to all the bureaus. Highly recommend that you hire a professional to do all of that, because it is exhausting and nauseating to figure out on your own. Okay, next, let's talk about down payment. Let's talk about all the myths, the different loan types, and the requirements for the down payments. First-time homebuyers, you can go as low as 3% down on a conventional loan as a first-time homebuyer. If you're buying for your second time unconventional, you can do 5% down. Obviously, you can go as high as you want, but those are the minimums on a conventional loan. It's important to understand that if you owned a home over 3 years ago, you still qualify as a first-time homebuyer. That's a really important distinction that most people don't understand. So first-time homebuyer is this is your first home purchase ever, or you haven't actually owned a home in over 3 years. Really important distinction. Now let's go to FHA. On an FHA loan, everyone can go as low as 3.5% down. You don't have to be a first-time homebuyer. So 3.5% down or greater on FHA. Then we go to the VA loan. Most of them you can do 0 down. There are some exceptions to that. For example, if you're using VA for a second time and you already have a VA loan, they will oftentimes require a down payment in that scenario. There's another scenario that if you use a VA loan and you have a co-signer that's not your spouse, that could require a down payment of, let's say, 12.5%. Those are the variables on a VA loan. Next up, we have what's called a non-QM loan, which we'll talk more about those later. That just means it's a non-qualified mortgage, so non-Fannie Mae, non-Freddie Mac. Those are all over the place. They're private loans. They're always changing. So you have to check with your lender to see what options are available for things like a bank statement loan. Oftentimes you can go as low as 10% down. P&L loans, or profit and loss statement loans, those are also go as low as 10% down. So those are based on your credit score. They will put up a plan for you dictating what the down payment's going to be. Lastly would be the USDA. Sometimes people call them rural development loans. Those also can be 0 down. They're great, but they have lots of restrictions, which we'll get into later. Next, let's talk about closing costs. These are the hidden costs that people forget to budget. Really important to understand what these are, especially as a first-time home buyer. Closing costs can drastically change dependent on a couple of factors. One major one is where you live. For example, states like Texas have very high real estate taxes, and that's because there's no state income tax, which is a beautiful thing, but they're going to get their money somehow. So they do it in the form of high real estate taxes. And a lot of times, once you get into nice areas, they have great schools those taxes are actually going towards something valuable. If you have a family and you want to send your kids to good schools and not have to pay for it. So it's just something important to understand. But the key is knowing what those are so you can budget for them in advance. In an area like Texas that has good schools in some major cities, you might have to budget as much as 4%, 5% for closing costs to cover everything involved. Now, there's an important distinction that we have to understand, and it's a misnomenclature. People think of closing costs as just everything, and it's not. Closing costs would be the fees. So your lender fees, your title fees, those are the closing costs. And then any of the fees related to the county or the state, those are costs. There's another section called prepaids. And although they get bundled together, those are actually a separate line item. So prepaids are things like taxes and insurance. Like I mentioned earlier, taxes in an area like Texas could be really high. But if you go to another part of the country, let's say Louisiana or Mississippi, staying along the southern coast, the taxes are very, very low. Property values are not as high. So those closing costs would be a lot lower. The other part is insurance. If you live in a coastal area, let's say southern Florida or parts of Texas and Louisiana, again, where insurance is really high right now, your closing costs or prepaids will be higher because you've got to cover the cost of that insurance. You're prepaying the first year of insurance, and then you're prorating the year of taxes that you owe from the time you own the house until the bill is due that the seller has already paid for you. So you have to factor all of that in to come up with an overall budget when you're buying your first home. And it's really important that you ask your lender and your real estate agent so you can kind of hone in on what these costs are. They could be as low as 2.5%. It could be as high as 5%. And I've even seen higher. When you get to over 4, what typically happens is people are using a strategy called an interest rate buy down to get a lower mortgage interest rate because of their budget, and that's just where they want to be at. That will increase your closing costs because the points you pay to buy the rate down gets lumped into the origination charges coming from your lender, and that gets captured in the closing cost section. No one's trying to pull anything over on you when they tell you, hey, it's going to be about 3% closing costs, but then you get into the process further down the line and you're wanting to buy your rate down and you spend 1% of the loan to buy it down. Now your closing costs went to 4% or something close to that. It was a choice you made by buying the rate down. And there's nothing wrong with that. You have to understand what the best strategy is based on the outcome that you want, which again is different for everybody. So it's critical to ask the questions up front or to be asked up front by your lender what the strategy is, and they can kind of help you budget and see what makes the most sense for your specific situation in your specific area. Really critical to have all of this figured out on the front end so there's no surprises. Next, let's talk about income stability. This is what lenders look for. And the reason is they have to figure out if you have the ability to repay the loan, right? Pretty normal. It's so funny to me how people get all bent out of shape when lenders ask these questions, but they want the $400,000 check to buy the house. It's not a big deal, guys. We're trying to figure out if you can repay the loan. So we have to make sure you have a stable job to understand your likelihood of repaying the loan while fitting inside the guidelines and the rules that we have to abide by. We'll talk more about this later and what this looks like and the how, but if you're hopping from job to job to job and you have all these gaps in your income, you stopped working for a year for no reason and we don't know why, it's just going to create chaos and problems. And so the likelihood when you're in that situation and there's no cause, no good cause for you having those lapses in jobs, the lenders are less likely to want to lend you money because they're not sure you're going to have a job to be able to pay back the mortgage. Pretty reasonable thing to ask, right, and request. So the income stability, there are very specific questions that they're looking for. What's your last 2 years of history look like? If you're self-employed versus a W-2 employee, that really matters because the guidelines tell us if you're self-employed, we have to look for 2 years of history and we have to take an average of that income in order to understand what number we can use for your income to calculate your debt to income ratio, which we will get into more later. But that's all part of the stability of your income. It's a different formula when you're self-employed versus not, and a little bit different of a timeline restriction when you're self-employed versus you're not. All of this is going towards income stability, a very important factor. Your lender will go through what they require, but it should look something similar to what I just described. 2 years for self-employed is key. We've got to show the tax returns. If you're a W-2 employee, we want to see a 2-year history of work, but it doesn't need to be at that same job. So you have a lot more flexibility. And the real cool hack is they're not looking at what did you make last year if you're W-2. They just want to know what you're making right now. As long as there wasn't some drastic increase from last year to now, you can get the new income to fly. So that's a really big deal. Don't think because you only made $50,000 last year and now you're making 7 year, you made 200 last year and now you're at 250, that they're going to be using an average. They don't. They're going to look at the most recent pay stubs when you're a W-2 employee to go towards your debt to income ratio and look at your income stability factor. Debt to income ratio, the reason why this is so important is we're trying to figure out, again, your ability to repay the loan. And so there's guidelines that have to be within a certain ratio specifically in order to qualify for a loan. For example, you make $10,000 a month. It would be really wild to have a mortgage that is $7,000 a month. That's 70% ratio if you had no other debt at all, which most people do have some other debts. So they don't want you to have a $7,000 mortgage if you're only making $10,000 because it's unlikely that you'll be able to continue to pay that mortgage because we all know that there's lots of other expenses in life, like car loans and student loans and credit cards and all these other things that Americans do. So it's really important. Every single loan type has a different set of rules for debt to income ratio. We will put them on the screen so you guys can see the chart and have an understanding of what it is. But when you're on a conventional versus FHA versus VA versus USDA, and then remember the non-QM loans, they all have different rules. So we have to understand what they are based on the actual loan that you're going to apply for or that you're going to qualify for. All right, let's talk about your budget. This is something that most people miss. Every time we talk to a first-time home buyer, we will always ask, what is your budget? And I don't just mean your house budget, how much the house is going to cost. I mean your monthly budget. Just because a lender tells you, hey, you qualify for X amount of dollars and that yields you a $5,000 a month payment doesn't mean that's a good idea. You have to first establish your household budget, with your family, or if you don't have a family, by yourself, and figure out what that means and explain to your lender, this is what I want to pay every month, nothing more. You can then reverse engineer a sales price, a purchase price that's very comfortable for you, to him or to her, and you give that information to your real estate agent. That will give them a very targeted, laser-focused approach to make sure you stay on budget, because you don't want to look at houses that you can't afford because it doesn't fit your budget. As a painful, terrible way to live life, I do not want you guys to fall into that trap. So critical to understand it. The components that we have to factor in on a budget are your principal and interest payments. That's the first line item. And the interest will always be a lot larger than the principal. So keep that in mind. Secondly, real estate taxes have to be paid. You can either escrow those taxes or not. If you escrow them, they will be part of your monthly payment. Now, not all lenders allow you to make that decision. You have to find out if they are okay with you having the flexibility to escrow or not. Every loan type is different on that subject. But if you escrow them, they will be part of your monthly payment, and we will collect them at closing. Lastly, insurance is a choice you make. You pick your insurance. It's highly recommended that you go to a broker that can shop the market for you and get competitive rates. That way you can make sure you're getting the best deal. Always bundle with auto and everything else they offer. That's how you drive the cost down. One thing to understand with insurance though is every single insurance, the carrier, like Progressive is a carrier, whether you get Progressive from one Progressive person or the other, it's the same price. It's illegal for them to charge something different for the premium. Makes the shopping very, very easy. Pick the person you trust, go with them. They will get you the same rate as the next person within the carrier. If you go to a different carrier, like a State Farm, they are what's called a captive insurance agency. Nobody else can sell them except them. So when you go to them and you want to shop, maybe you go to a broker who has a bunch of options, and then you go to a captive, like a State Farm, and you compare and you see what makes the most sense. So it's really important to understand that. So that's part of your budget. Let's say your tax budget was $250 a month. That's part of your payment. So principal and interest, one section, taxes next, insurance next. And then lastly is the homeowners association, if there is one. So that is the last part. Not all homes have it, so it's not relevant all the time. But you want to have an understanding. If you're in a very high-end neighborhood and they have a high HOA, you have to include that in your budget. Or if you're in a condo, for example, with lots and lots of amenities, that should be part of your budget so you don't get caught with your pants down. That's not good. All right, that was a lot of information. Rest assured that if you follow these steps and you understand this information methodically, it is a smooth process. I just want you to have all the information up front. But when you have these conversations, you can make sure you're talking to someone that doesn't ask you. You've already got it written down. You'll be very, very prepared to have an excellent process to purchase your first home. All right, let's talk about down payment assistance programs. There are a lot of these out there, guys. I have mixed feelings about them because what typically happens a lot of times when you use these DPAs, they call them, they've got to fund them somehow. They typically have pretty egregious rates attached to them and lots of restrictions. So I would always recommend that you save your money instead of using these DPA programs, but it doesn't hurt to ask. Worst case scenario is you look at it, you don't like it, and there's nothing wrong with that. But a lot of times they just have too many strings attached to them. You use a DPA program, and you can't sell the house for 3 years, you can't rent it out, it straps you. And if you do sell the house, you got to pay the money back. Now, there are some that are good. They come and they go. So it's worth checking out the different programs that are out there and just seeing what's available. Depending on where you live, your income level, and whether you're a veteran, you might qualify for different grants. Some of them are forgivable, or there might be some special programs with your work. There's all kinds of things out there. They change all the time. So you have to research them. The state and local ones are typically geared towards first-time home buyers. If you're gonna do something like that, you really want the ones that are grants because those typically don't have to be paid back. Any of the ones that are tethered to a loan, like a second lien on the property, a lot of times have high interest rates, which can be kind of painful. If you're in a rapidly appreciating market, not a big deal, but you have to be very wary of the high interest rates on those. I'm a big proponent of when the grants come out to use those if I was going to compare the two. They also have the employee assistance ones. They're pretty rare now, but they do have companies that offer these, as well as some nonprofits that have stuff like this. The problem with them is whenever you use one, you're typically tethered to a pretty terrible lender. It's very difficult for a lender to service these types of programs. So most of the best lenders stay away from them because they make them so difficult that they just don't want to mess with them. So honestly, if you do it, just be very cautious. It may be worth it for you if you have lots of time and you don't stress easily, because there's probably going to be a lot of turbulence when you're in process and lots of paperwork and lots of extra just stuff to do. So if none of that bothers you, then go for it. But just be very weary of something that kind of sounds too good to be true. Now, it's important to understand, remember, there's 2 loans that don't require down payments. So if you're a veteran and you have eligible benefits, you don't need any of this because you're doing a 0 down loan most likely. And the same thing with the USDA. The USDA loan doesn't require a down payment. So either of those would be great alternatives if you fall into those categories of approved for them to use in lieu of a DPA program. So remember, it's really important that you ask your lender and you research with your employer and your local officials. Look on the county website or parish website if you're a Louisiana person and see what's available there. Just remember, you might get tethered to a pretty poor lender if you use those programs, but they're out there, and see if it makes sense for you. Once you know you're ready financially, the next step is getting your team in place. And this is where most first-time homebuyers make their first big mistake. You have to build the perfect team. Buying a home is not a solo sport. You have to qualify the team because it directly impacts how smooth this process is going to go and how much money you spend. So let me break down for you exactly what you need to do. Think of a chair. You're sitting on a stool and you've got 4 legs. One leg is the real estate agent. The other leg is the title company. Then you have the insurance person. Then you have the lender. If any one of those legs breaks, your head's cracked open. That's what you want to absolutely avoid. So first, let's talk about the real estate agent. So in this case, if you're a first-time home buyer, the buyer's agent, they are going to guide you through the process of selecting a home. It's really important that you find someone with a tremendous amount of experience so they can represent your best interest. They are worth their weight in gold if you find the right one. And not all realtors are created equal. I would highly recommend that you find someone that has experience with your specific price point in your specific area that you're looking. For example, you don't want to call some multi-million-dollar agent that works at that price point, has no time, and you're buying a $200,000 home. They won't have time for you, and it's going to create typically a bad representation of how agents should operate. And you're not going to like it because they're not going to make all of the resources that you need available to you. You want to be right size with who you talk to. Find someone that has comfortability in your price point and makes the time for the needs that you have. Now, this doesn't mean that they need to be available for you 24/7. Real estate agents, just like the rest of us that are self-employed, have lives. We have kids, we've got families we have to tend to. So it's not 24/7. We want to respect people's times, but we want to find people that are excellent, that are organized. They're not just opening doors. They understand market research. They understand the ups and downs and the ebbs and flows of pricing. They understand how to negotiate, and they understand when to walk away. It's not all about the commission check. So it's critical that you find the right person, because honestly, 70% of the people after a transaction say that they don't trust their realtor after the deal was done. You don't want to fall into this category. So let's talk about a few things that you want to ask your real estate agent that are really important. You want to know the price point and the areas they've worked in. So just ask them, hey, what's your average price point that you typically sell in? Do you typically work with buyers or sellers? What do you prefer to work with? Let's see if they're honest with you and see who they actually are servicing so you can figure out if it's a good fit for you. Do you work with first-time home buyers? What are your hours that you're available? Let's see what they say to make sure there's a really good fit for you. Another big thing to ask right now is, hey, what is the commission that you get paid and how do you get paid? You guys have to understand this. The laws have changed on buyer rep commissions. I am a big proponent of using a real estate agent. However, you have to understand the possible risk. For example, you find a for sale by owner home not being represented. They don't want to pay your agent. You're going to have to pay that agent's commission. Now, it doesn't mean you have to come out of pocket and pay for it cash. You can work that into your loan, but you need to be aware what it is and what the risks are. Most agents should be making you sign a buyer rep agreement, and those will dictate exactly what the rules of engagement are as far as that commission goes. It's really important to ask. Don't be afraid to sign those documents. Most agents that are really good, they want to work with people that want to work with them but they're not legally allowed to show you a house without that sign. So if you want to see the house, you have to sign that agreement. I would say, ask them, hey, if this doesn't work out, will you let me out of the agreement? And most of them will do that. I've very rarely heard of anyone saying, no, you're locked in once you're locked in, because at the end of the day, you're just not going to see houses, and it's just the document means nothing at that point because you're not going to actually transact or buy. All right, let's talk about the mortgage lender. Some people call them loan officers. These are the ones that get you the money. Really critical that you find the right person. You have retail operations, which is the old school bank kind of companies that you walk into. And then you have the other channel, which is the wholesale channel, the broker channel. It's important to understand the differences. Typically, I'd say on average, retail is significantly more expensive in most markets than the wholesale broker channel. The reason is because they have decades and decades of overhead and brick and mortar operations that are very expensive, thousands and thousands of employees, middle management that do very little to help you. They're just trying to keep their job and not get fired. All of that costs a tremendous amount of money. So I highly recommend staying away from most retail operations. I'm sure there's great people there, but at the end of the day, this is your home purchase. You need to get an incredible deal and you need to have excellent service. I'm a much bigger proponent on the wholesale channel. The wholesale channel covers brokers and correspondent lenders. These types of organizations are typically lean. The service is very, very high. The speed is incredibly fast, and the rates are a lot sharper with lower fees. I would say it's more important to understand and trust this person than anybody else. And the reason is because at the end of the day, you've got to live with this thing that you bought for a 30-year period or until you refinance or sell the house. So it can really make or break you. The realtor's just as important, to be clear, but I would say these are the top two most important parts of the process and most important parts of your team. So you want to find someone you trust. You want to find someone that can meet you where you are, that has the speed and the service that you need to be very, very comfortable. And most importantly, as a first-time home buyer, they have to go through with great detail, explaining all of your options and asking you what you want. Because at the end of the day, that's what matters. They need to understand how to connect your desires to their products and solutions. Very simple, but it's something most people forget is these lenders are so rushed to get you to apply and get it done and pull your credit. They forget to ask you, hey, why are you doing this? Or what's your budget? Just basic questions that you've got to understand. Next up, let's talk about title companies. Another really important part of the process. Title companies are not something that most people talk about because most people don't know them or care about them because they don't interact during the process a whole lot. There are good and there are bad title companies. Most of the times, the title side of the transaction is very smooth, but you have to remember these guys are handling the legal transfer of your property, protecting your ownership. If you have a sloppy title company that didn't do their job, it could cause some serious risks for you down the road with your ownership of your property. Having the right title insurance is critical. There's two types of title insurances you have to understand though. You have lender's title insurance and then you have owner's title insurance. The title companies should be going through with you what these are so you can figure out if it makes sense to buy these items. Now the lender's one, you don't have the option. It's required, but you don't have to buy title insurance as an owner. You probably should because it protects your ownership. But a good title company will go through all of this for you, and they will also be very flexible on where you close. These old school title companies that don't want you to do virtual closings are just insane. Find a title company that will allow what we call a virtual closing or a hybrid closing. What that means is that when it's time to sign your paperwork, you can do it at your house, you can do it at your friend's house, you can do it at the new house, you can do it anywhere you want. They send remote operations to you to handle everything. So there's lots of options out there. Just find someone that's up to date. Make sure that they have technology to send money back and forth. Fraud is at an all-time high right now. I have seen lots of people that have been taking advantage of this with hackers inside of their emails, fishing around and finding information, posing as title companies, posing as real estate agents, and having people send them money during a transaction in a wire fraud scam. Title companies these days, the good ones, have apps and software to transfer money between your bank account directly to them so you know it's safe and secure without having to perform a wire transfer, eliminating a lot of the risk that people see. Next up, let's talk about insurance company. Like I mentioned earlier, insurance is important, but you've got to find the right type of insurance for your risk tolerance. Remember, the definition of insurance is spreading risk over a lot of different people. So if you think of it that way, you have to understand that there are times when insurance company A, let's say State Farm, no longer wants or needs any more customers in certain area because their risk has already been spread and mitigated to their liking. So at that point, what they do is they raise their premiums because they don't want any more customers. Now they're not going to turn you down, but they're going to make it unattractive. At that point, you have to look for Allstate, or you have to look at Safeco or some other company that wants your business because they want to continue to spread their risk. That's how the game works. So it's important to understand that just because State Farm or Allstate or whomever else in one market was the best company for you doesn't mean in another city or in the same market 5 years later is still the best option. Don't be married to a single company. The thought that they give you better rates because you've been there longer is really not true. They don't do that. They might give you perks, but it's not from a premium perspective. It might be a small discount that the person that was only there 2 years also got. So the value is not there. Shop it, shop it, shop it. It's really important. Which brings me to who you pick. Find a broker that works your market, that can shop the market for you so you don't have to. Remember what I said earlier, all insurance from carrier to carrier costs exactly the same. So find someone you like and have them shop the market for you. That is the absolute best way to make sure you get the best deal. Another part of the transaction, which wasn't on my stool analogy, is a home inspector. I don't put it in the stool analogy because it's not required, but it's a really, really good idea to get a home inspection. They will tell you everything about the house, what you can expect to break, what needs to be fixed. It really gives you a magnifying glass approach to everything home related. As a first-time home buyer, highly, highly recommend you get a home inspection and you protect yourself to know what's going on with the house, to make sure you're not buying something that's going to create massive amount of cost and headache for you. Your real estate agent can typically find the best home inspector for your market, for your type of house. One other person that gets left behind is typically the home warranty companies. I'm a big proponent of home warranties. I have used them many, many times for myself. What they do is it is a warranty for certain parts of your home. For example, your HVAC, your pool heater, your plumbing, those can all be protected from a home warranty with very minimal deductibles for very minimal cost. A really good way to kind of hedge your bet and have a balanced downside. So those are all the players in a transaction that you have to consider. Now that you know who you need on your team, let's talk about the first real step in the buying process. And this is where everything starts to get real. It's not buying a house. You got to get pre-approved first. That's the first real step. I cannot tell you how many times I've seen first-time home buyers to start looking at homes before they're pre-approved. They find their dream home. They want to make an offer. They have no idea what they're doing, and they find out they literally can't afford it. Or worse, they can afford it, but they don't have a pre-approval letter and someone else gets it first. That will create a terrible first process. Don't do that. Pre-approval needs to happen first before you start looking, period. Let's go through the step-by-step process of what the pre-approval looks like. First off, you need to get your documents together. Pay stubs, tax returns, bank statements. All of these things is what the lender needs to pre-approve you to talk about your debt to income ratio. We talked about that earlier. So if you're not self-employed, so your taxes are being withheld, you're a W-2 employee. The lender's going to need your last 2 W-2s. They're typically going to need your last 2 pay stubs. If you have variable income, lots of bonus income or commissions, they're also likely going to need the last 2 pay stubs for the previous 2 years. All of those together will give them the financial picture they need. They may need your tax returns, but they shouldn't need those tax returns unless you own other properties that are rentals or you have other passive incomes or write-offs or you own a business, over 25%. Also, they're going to need all of your asset statements. That could be bank statements, it could be retirement accounts, all of the things that have assets that are valuable, that are liquid. You need to show them those so they can establish where your cash is coming from. You have to see where that money comes from. You can also get a gift, which is a very popular thing for first-time homebuyers. They have a family member that's going to give them, some money to help with the down payment. We just basically create a gift letter saying that you don't have to repay that gift, and that will suffice in lieu of having the money in your bank account. So don't stress if you don't have the money and you're getting a gift. You could just use a gift letter. It's very common, super easy to do. As I said before, the lender's looking at these to understand what your documented income is. They have to follow the exact Fannie and Freddie guidelines. They don't have an opinion of what it's supposed to look like. They're just trying to follow the exact rules. Why do they do this? In the mortgage world, loans are sold all the time. In order for the market to keep flourishing on Wall Street, they have to band all of these loans together and package them. So in order to package books of loans, you have to kind of look and feel the same way from a risk mitigation standpoint. That's why there are guidelines to avoid the crash that happened back in 08-09 era. So that's why we look at those things. That's why they fit them into the guidelines. It's critical to understand that. So after your asset statements, we'll need to collect a copy of your ID. If you're not a US citizen, then we need any sort of visa that you have or green card, anything like that, we've got to collect. All right, let's talk about the difference from a pre-qualification and a pre-approval. A lot of these big banks, these retail operations will do something called a pre-qual. It may seem like it's a good idea, but it's really just a big waste of time. Well, they'll do a soft credit check, and then within minutes of putting in a couple numbers, they're just going to give you a letter that says you've been pre-qualified. They've done no actual underwriting work to figure out if you can buy what they're saying you can buy. There's different versions of it, but if you get a really good lender, they're going to do something called a pre-underwrite. And what this means is they're going to collect and review all of your documents to where we have incredibly high certainty that we know what's going to happen during the transaction. The reason they do this is because we want to protect you as a buyer, to make sure that nothing blows up after you've started spending money in the transaction. If you don't do this on the front end, this pre-underwrite, what's going to happen, or what could happen, is you get a pre-approval. It's soft, it's weak. They didn't really do a thorough job, right? They did it in 20 minutes and then here it goes. You write a contract on a house. You don't know what's going on. You're drinking out of a fire hose. The realtor calls you and says, hey, I've scheduled your home inspection, $700. Then the lender calls you and says, hey, I got to send the appraisal, $600. Or you start spending all this money, and next thing you know, he's like, he or she says, oh my God, I didn't realize you had a student loan. It wasn't on your credit report. You no longer qualify. Then you're looking backwards saying, I need to get this money back. Not coming back. Those went to third parties. They're not going to give you that money back because the services have already been performed. The other thing, which even worse could happen, if you're out of your option period or out of your finance period, you're at risk of losing your earnest money deposit, or even worse, possibly getting sued, depending on what state you're in, for lack of performance on the contract. These are all horrible things. Don't be afraid. Like I said before, pick the right team. They can help you make sure you don't run into these traps. Really important, on your pre-approval, let the lender take the time to do a full pre-underwrite so they know exactly what's going on. And here's one thing that they don't tell you. You can do this without a hard credit pull. If somebody tells you, we gotta do a hard credit pull, they're probably lying. People say this because they know once you do the hard pull, you're very reluctant to let somebody else do it. So maybe you stick with them. It's a tactic that's not necessary. Don't get caught in that trap. Now, there's a couple exceptions. On a VA loan, if it's kind of a shaky situation, the credit's not great, you do need to do a hard pull to get an actual AUS approval. So that case I understand. And some FHA loans as well, you might need to do it. But for most situations, it is totally not necessary. All right, typically these pre-approvals take about a few hours if you're really strong. Sometimes it can take a couple of days if you have a lot of variable income and just complicated documents. But most lenders turn this around the same day or next day, as long as it's not super complicated, typically Monday through Friday. So you apply on a Thursday, you should have your approval back, pre-approval, later that day or maybe the next day. That pre-approval by law is good for 90 days. To get a new one is really not that big of a deal. All we have to do is refresh your documents, get updated pay stubs, updated bank statements, and then we're good to go. As long as you don't go do something ridiculous like buy a yacht. It's really what they call caveat emptor. Buyer beware. You're responsible for whatever changes happened between the time we wrote the pre-approval letter that you disclosed to us. Hey, I just bought a yacht. Right? So I have a lot more debt now. Could you please rerun everything with this new information? So if something changes from the time you get your letter, all bets are off, right? You have to let the lender know that you did what you did. Now, if you're shopping your rates and you want to bounce around to a number of different companies, you can do it without hurting your credit. Just remember, like I said earlier, don't let people do hard credit pull on you unless you have terrible credit, because it's just not necessary. You should be able to get rates, just a soft check, very easily without having any impact on your credit whatsoever. Now, before you get that pre-approval, it's probably worth understanding the different types of loans that are available. And this will dictate your down payment, your rates, and your total monthly cost, and any other fees associated with that loan type. Now, there are 5 main types of mortgage loans, and picking the right one can save you tens of thousands of dollars over the life of the loan. Let me break down each one for you right now. First up, the conventional loan. This typically requires first-time home buyers 3. After that, people typically are between 5 and 20%. Now, these have the best rates if you have a credit score of about a 760 or higher. And at 20% down, there's no private mortgage insurance required. If you put less than 20, you will have to do a private mortgage insurance line item on your loan. We'll go over what that means later on. And it's best for buyers with typically strong credit and some savings in the bank. That's kind of the metrics that it really likes to give you the most attractive rate. I would say you could still get a conventional loan as low as maybe 640, 650, but it's not a big advantage because the rates are a lot higher. When you get to that credit rating, you're probably going to switch to the next category of loan, which is called an FHA loan. Now, these require only 3.5% down, and the minimum credit score, as I said earlier, is 580. They have a lot more flexibility on the requirements for the debt to income ratio. Now, these do require private mortgage insurance for the entire life of the loan or until you refinance. These are best for first-time home buyers with low credit and that have smaller savings and higher debt to income ratios. Next up, VA loans, 0 down payment required, no PMI ever. These are only for veterans and any eligible spouses with survivorship rights. It's a little complicated, but you can, as a survivor spouse, you can use that benefit. What's important to understand though, as a veteran with active military benefits, you cannot have a co-signer and get 0 down. That's not a spouse. What's odd is that the VA will tell you, oh, we allow it. It's nonsense. They do not. What they don't tell you is they allow it, but they won't underwrite and back the entire loan, which means they don't actually allow it. They do only a portion of it, which means they have to increase the down payment to 12.5%. Those are rare cases, but if you're a veteran, don't have a cosigner. If you want 0 down, that's not your spouse. This loan's perfect for anybody who qualifies. It is the best deal on the planet, but you have to be a veteran with active benefits. That's the only way it works. If your benefits are not active, you can go and get them active by contacting the VA and making sure your COE, certificate of eligibility, is up to date, which your lender can then pull to make sure that you fully qualify for whatever home you're purchasing. Next up, USDA loans, otherwise people call them rural development loans. These also have 0 down capabilities. They're typically for rural and some suburban areas. And there's a lot more of these than you'd probably think. It's just people don't really pay attention to them. The challenge with these loans is there's a lot of restrictions on the income. They're best for buyers in these eligible areas that meet their required income requirements, which the debt to income ratio has to be below 42, which is kind of hard to get. And the credit has to be above 640, sometimes 620, but those are tighter restrictions in FHA. So a lot of people fall out of this once we get into it. But it is a really good loan because, again, there's no money down, which is an incredible option. Lastly, let's talk about number 5. This one is new to the game, called non-QM loans. These are your bank statement loans and your P&L loans. These are very popular when you're self-employed and you write off all your taxes. It's really important to understand something. Non-QM loans have a little bit of a higher interest rate. It could be a point, 1% higher, it could be 0.75%, it could be 1.5. The reason why that's not that big of a deal is because if you're applying for a loan like this, it's because you paid no taxes. You're using a bank statement loan because your tax returns show that you write everything off. Let me give you an example. You're a real estate agent and you brought home $300,000 worth of commission, but you're only showing an adjusted gross income of $150,000, but you need to show about $250,000 in order to qualify for the house that you actually want. You saved a ton of money on taxes, paying an extra 0.5% on rate or 0.75% rather than writing off all of that $150,000 of income is a major victory. It's much better to actually continue to pay those less taxes than to eat another 0.5% in interest on a mortgage monthly payment. You just have to understand it to be comfortable with it. Nobody's trying to take advantage of you, but those loans have higher risk because we're not really documenting income. A bank statement loan is just like it sounds. We're using 12 to 24 months of bank statements and just looking at your deposits. We're not looking at anything else as far as income goes. So that deposit, let's say you're depositing $20,000 a month, based on the profession you're in, there's some sort of an expense ratio. Let's say it's 50%. Therefore, $20,000 a month of business deposits, expense ratio is 50, your income is $10,000, $120,000 per year. That's how it's calculated. It's literally that simple. The next one is a P&L loan. This is a profit and loss statement loan. This has probably the highest interest rates of the two because it's even less documentation. You're just looking at audited P&L financials from a CPA, and that's what they're using to actually qualify you for your business. And it's a personal loan. Two more, there's a DSCR loan, debt service coverage ratio. That is no income at all. We're just looking at the ability to repay the loan based on the ratio. The ratio is your rent and your expenses compared to what the appraisal rent comes back at. So that ratio is how you get approved for the loan. It's great for investor loans. You can actually use your LLC and put this loan in the LLC company rather than in your personal name. This is how most investors scale up rental properties very fast when rates are not so good. And then when rates drop, appreciation comes skyrocketing, and then they refi and cash out. That's a huge hack that investors do. And they use this DSCR product in order to do it. Typically, you can go as low as 10% down. Most people do as much as 20 to 25. And you want to have decent credit, right? So at least 680, but it's better to have more like mid sevens to get a really good deal. The last non-QM loan I want to talk about is basically a no doc loan. Right? All we're doing is looking at your credit score and then assets in the bank for 12 months worth of reserves and then a 25% down payment. Okay, now let's talk about PMI. We mentioned it above earlier. Let's talk about what it is and how to actually avoid it. So if you're putting less than 20% down on a conventional loan, you're going to pay a PMI, but it's not the end of the world. What you should understand is what it is and how to actually get rid of it. First off, it doesn't protect you at all. So it doesn't serve you. Therefore, you shouldn't want it. It only protects the lender. It is private mortgage insurance, and it's protecting the lender from you defaulting. The typical cost is about 0.5% to 1% of the loan amount per year. And that can vary based on your actual credit score and on your down payment. But here's the real important thing to remember. Lenders shop this PMI on your behalf. So if you do business with a lender that is not savvy enough to shop their PMI, you're going to pay a premium for no good reason. Highly encourage you to press the issue of what your PMI costs with lender A versus lender B, because for the exact same rate, you could pay or lose $50 to $100 per month with bad PMI rates. So it's really important to ask that question to your lender. Now, on a conventional loan, once you reach 20% equity, you can request to remove the private mortgage insurance. And they don't have to technically do it immediately, but once you get to 22%, by law, they have to get rid of it. Now, that might force them to go out there and appraise the property, and they might tell you to pay for it, but reach out to your realtor or your lender and ask them what they think your home is worth, and that'll give you a good indication if it's a safe bet to go ahead and make that request. When it comes to FHA mortgages, the PMI stays on it for the life of the loan. It doesn't matter what down payment you put. So you have to be very mindful of what that cost is so you know what you're getting yourself into from a monthly payment perspective. Don't just rely on your online calculators and forgetting the PMI number, because that can make a big difference on your monthly payment. Next, let's talk about fixed rate mortgages versus adjustable rate mortgages. You'll need to make this distinction and figure out what is the best for you. Historically, adjustable rate mortgages have been very volatile, and it's really something that people stopped using some time ago when the market crashed. There is the right time and a place for an adjustable rate mortgage, but you have to be very cautious and decide when the time is right, and if you're willing to gamble a little bit. Here's the very simple breakdown. A fixed mortgage is just like it sounds. The rate is fixed for some period of time, whether it's 10, 15, 20, or 30 years. It's incredibly predictable, and it won't move unless you move it, meaning you refinance it. With an ARM, adjustable rate mortgage, the rate is lower initially, but that can change after 5, 7, or 10 years. Now, it makes sense if you plan to move before that time frame and you're sure about that, or you just want to gamble and hedge that, you'll be able to refinance to a better rate before that adjustable rate comes up. Because once that hits, it becomes very unpredictable on what the rate will be, which can drastically hurt your monthly payments. So something to be very, very mindful of. Now, once you find a rate you like, then you can lock it in. And here's how that works. You're telling your lender that you agree to the lock rate, and they go in the system and they actually click the lock button. And that can be for typically a period of between 30 to 60 days is normal. There are some times in the market where you can do extended lock periods when people feel like rates are going to go flying high. They'll offer these extended locks. They typically cost something, so you have to be mindful of what you're paying for that hedge. But once you lock your rate, it should not change unless something happens where you extend out past that lock period. Now, you can extend that lock for a cost, and sometimes lenders will offer you what's called float down options. And that means if rates improve, you'll get the benefit of the lower rate from the time you locked it until the time you went to closing. If they're not charging you, they've typically baked in the cost of the float down into the original rate. So if you get a float down, you probably have already paid for it in the original rate. You probably got a little bit of a bump. Not a big deal, but it is something to be really mindful of. An extension cost, like I said earlier, sometimes things get delayed in contracts where you think you're going to close in 30 days or 40 days or 15 days, and the contract pushes out. Now, it's really important to understand who's at fault for making that contract needing to get extended out. Because if it's you, buyer, and you're in breach of contract, that could cause some serious issues with basically your agreement with the seller. Your earnest money deposit is at risk and other things. So you have to be careful to make sure that whatever task your lender assigns you, or your realtor, or your insurance person, or your title company, that you do them in a very timely fashion. So if something does come up, you hope it's on the other party and not on you, relieving you of the risk. When you have to extend your lock, those things typically cost money. Now, some lenders will give you a buffer a few days free, but outside of that, they have to charge you something. And it's so many basis points per day. Sometimes it's 5 basis points, which is 0.005, or 10 basis points. It's going to cost something, and it's just a matter of who's paying for it. A lot of times, if it's the seller's fault, you can have your agent negotiate for the seller to help offset those costs and pay for that lock extension for you. Now, as a first-time homebuyer, you might qualify for some special programs and tax benefits. So be sure not to leave any money on the table. There's a lot of state-specific ones as far as down payment assistance, and there's something called mortgage credit certificates, MCC. Those are tax credits for mortgage interest. Those are really powerful. Now they're starting to fade away, so you have to check at the time you're viewing this video. Make sure that they're still active for you and that you can actually use those credits. It's a really good tool if available in your market. First-time homebuyer exemptions. There are lots of times where you have fees associated with the lending process. And as a first-time homebuyer, the lender will exempt you from certain fees, or they remove certain overlays. An overlay on a rate is when we look at the pricing of what a rate costs, they will add or subtract certain line items that will increase or decrease the rate costs. And with a first-time home buyer, you can actually sometimes get those removed as the incentive. It doesn't make sense until you look at the numbers, but when you get into looking at your fee sheets with your lender, ask them that question. What are my first-time homebuyer incentives that you can offer? And they should be able to articulate exactly what those are, how they come over to you in the form of dollars and cents. All right, let's talk about IRA withdrawal rules. This is really important to understand. There's a lot of flexibility with IRA servicers to allow first-time homebuyers to use their money penalty-free in order to purchase a home. But there are a lot of rules around this. So be very, very cautious at asking a lot of questions and get it in writing from your servicer. Ask them how much money you can pull specifically, and if there's any penalty, or do you have to pay it back? Understand those limits, understand how fast you can get the money, so you can convey that information to your team, your real estate agent, and your lender, so they can best position you when you write the contract to have a smart cadence of days to do certain tasks so you don't fall out and bust your contract. All right, this is what you've been waiting for. You're pre-approved, you know your budget, and now it's time to go look at houses. This is the most exciting part of the process. A lot of first-time homebuyers make highly emotional decisions that they regret later. So it's really important to tune in here and get everything organized so we have no regrets. Here's a really big part of the process. You need to have a needs versus wants list. And I would highly recommend you put them in order. This takes all of the emotions and makes your prioritization very, very realistic. And if you're buying with someone, your husband or your wife, anybody else, make sure you guys share the list so you can both be on the same page. It's really key to have them in order, like I said, so that way when you're out there and you can't find the perfect house because it doesn't exist, you can logically eliminate certain homes that maybe don't check your top 3 priority boxes. But if number 7 isn't there, you could probably still proceed. It still may be the right house for you. You're not going to get everything in that list. So you have to stay very realistic with these selections. One of the biggest things is to focus on location. I always say, don't fall in love with the house, always fall in love with the location first. And the reason is, once you're there, you cannot change your surrounding. We can do lots of things to change the box, but we can't change the neighborhood we're in. We can't change the features. We cannot change the schools or the commute. We can't change the neighborhood or the resale value. So it's critical to fall in love with the location first, and then you drill down on the actual home. Now, this has gotten a lot more flexible because of remote work, but it's still the most important thing. The top 3 things in real estate they teach us is location, location, location. So get hyper obsessed and focused with that part of your selection. After you find the house, there's a lot of red flags and just things to watch out for that hopefully your agent will be talking to you about and trying to protect you from all of these items. First off, foundation issues. That's a major red flag. If your seller has disclosed there's foundation issues, not only will you not be able to get a loan because no lender will lend on a home with a foundation issue, but it will be an ugly problem that will come and rear its head down the road. And they're incredibly, incredibly expensive to fix. So if you have a foundation issue, make sure that it's been remediated by a licensed contractor with a warranty and get eyes on that. Water damage. These can be difficult to find, so it's important that you have a home inspector helping you to determine if there's damage throughout the house, behind the walls. They can create mold and all kinds of issues, especially for kids. So it's really important to know what to look for, and a good real estate agent as well as home inspector should be able to sniff those out for you. Outdated systems, those are things like HVAC, hot water heater. These can cost a significant amount of money. The last thing you want to be as a first-time home buyer is getting into a new home or an old home and the systems are outdated. And then before you know it, after the first month, you're spending $10,000, $20,000 on systems because they broke. You've got to make sure you understand the age of them and what to expect. You don't want to get caught buying a house that's a money pit because you didn't understand how long these systems would last. If you do this properly, you can hop off the emotional roller coaster and just methodically pick the right home and have an objective view as opposed to something that you're emotionally attached to. If you're looking at condos, townhomes, or many of the newer neighborhoods, you'll likely encounter something called an HOA. That's a homeowners association. HOAs can be great or they can be an absolute nightmare. Before you buy in an HOA community or a condo, be sure to investigate all the details. You have to know the cost every month. You have to know exactly what you're getting for that cost and have an understanding of how much they've been increasing. You also really have to understand the rules and restrictions surrounding that HOA. It's going to tell you what you can and can't do with your property, sometimes to the point of the paint colors you can select. For example, where I live, I can't have chickens. And I would love to have fresh eggs every morning right from my chicken coop, but I can't because I live in a master plan community and they don't allow it. You have to be mindful of what you want, what your lifestyle is lined up for, to make sure the HOA is a good fit. Also want to check the reserve funds. You have to understand not all of these HOAs are run properly, and a lot of them will have financial issues. The good news is your lender will help sniff that out. Once we go into underwriting, we're going to look at those financial statements, but I would also look at them yourself and learn to understand what the potential risks are if they're not in a financially healthy state, because essentially you're going to get that special assessment that they didn't plan for. And those will cover major repairs, issues in the streets or the buildings or whatever. Those issues can be very, very big, especially if you only have a small number of homes in the community. You can also review the meeting minutes of their most recent meetings and just kind of see what issues existed the prior year. And that should give you a good idea of what to expect for the future. So red flags to watch for: low reserves with aging infrastructures is a big problem. History of special assessments. If you find a place that constantly is assessing, that means they've got lots of problems going on. You can expect that to continue because the building's falling apart or the community is just under duress. Pending litigation. This is a huge one. If you have some big lawsuits or a big lawsuit, that can cost a significant amount of money that they pass along to the homeowners. Litigation can be really ugly. It can also prevent you from transferring ownership. So if you're in a pending litigation at an HOA or a condo, it's unlikely that the lender can actually close a loan for you because the litigation is still pending and they don't understand the risk. That can prevent you from even selling your home, something to be really, really cautious of. High percentage of rentals. This can also impede your ability to sell your house, as some HOAs only allow so many rentals as a ratio of the entire ownership portfolio. This can affect your financing. You may not even be able to get financing if there's too many rentals already in the community. So you found the house you love. Now the real negotiation begins and you get to make an offer. Now, making an offer on a house for the first time, it can be really nerve-wracking. You're about to commit to the biggest purchase of your life, and you have no idea if you're doing it right. So let me walk you through exactly how this works. Here are the components of the offer that you're about to make. First, you have your price. Then you've got the earnest money deposit, otherwise known as EMD. Then all of the contingencies, and then your close date. Those are the major components that go into the offer. And you determine your offer price based on the market value and offer strategy and your comps and your competition. So if a house is listed at $500,000, it doesn't mean that it's worth $500,000. We have no idea until we actually run the comps and see what it should sell for. List price is just the asking price. It's just a negotiating tactic. So don't get emotional about it. Use the data. Let your agent run the comps so you can figure out what the market value is. And you have to also understand who the competition is. If you're in a hot market and there's 5, 10, 15 people going after the same house, what do you think will happen? Escalations in offer price. People are going to offer over the market value in hopes to win that house because we have a supply and demand issue. When supply is down and demand is high, prices go up. So when there's lots of competition, typically the first thing you do is offer more money. So if you're in a competing offer situation, outside of just the price, you can look for certain contingencies, like how fast is your finance contingency expire? Do you have an offer option period or not? Those things can give your offer a higher boost outside of just offering more for the sales price. Also, how long is your appraisal contingency? Do you have an appraisal contingency? Those are things that in some states you can waive. You can waive your appraisal, you can waive your finance, two separate things. Not every state is the same on how those rules go, so you have to check with your local lender and your local real estate agent to give you that information on how to best strategically write the offer to get the optimal outcome that you want. The other contingencies that you can use to negotiate would be home inspection contingency. You can waive your ability to go and do the home inspection to find out what's going on with the house if you're in a competitive situation. You can increase or decrease your earnest money deposit, the percentage of your earnest money. Typically the lowest people go, actually I've seen earnest monies at 0. There are certain markets like rural Louisiana where the earnest money is nothing. They don't even have one. And I've seen as much as 3 to 4% of the purchase price. So it's entirely market driven. The closing date's another one. You can move the closing date to be a lot faster if that's what the seller wants. If the house is empty, a lot of sellers want to close as fast as possible because they want their money, right? And they don't want things to fall out. So using that as an advantage and finding a lender who can close super fast is a really big advantage, especially in a competitive situation. Besides your down payment, you have to budget for closing costs. I know I talked about this earlier, but it's worth bringing up again. These typically run between 2 and 5% of the total purchase price. I think I said 4.5 earlier, but let's call it 5 now to be conservative. It is a common thing that first-time home buyers get caught off guard with. And I'll be honest, a lot of lenders do not properly articulate this number because they're afraid of sounding like it's too high, but this is true. These numbers are real. 2 to 5% is a great range. The reason for the range, it's drastically dependent on the taxes for where you're buying. And if you're buying your rate down, that number could go up if you're using some money to get a more aggressive interest rate. So check with your lender to understand what that is before you go looking at a house to make sure you have enough cash or gift funds to cover those. Okay, let's break down what these closing costs are. From the lender perspective, you typically have loan origination fees. Most loans go anywhere between 0.25% to 1%. Now it can be higher, it can be lower. I'm just giving you national averages of what typically is charged from a loan origination fee. Now these can also be called rate buy downs because the loan origination fee is comprised of a couple of items. The underwriting fees, the buy down fees, all of that is in the origination section. But I would say most loans in America are 0.25 up to 1% of the loan amount. Some lenders charge application fees, $300 to $500. I would highly stay away from people that have app fees. I think it's kind of a junk fee and trash. An underwriting fee is very common. Most of the time they're around $1,200. Credit reports, they've gotten a lot more expensive. I would say about $150 per person is a good range. If you see people charging $500, $600 for a credit report, run for the hills. They're just trying to nickel and dime you and gain extra money from junk fees, but they are real and they do cost. An appraisal is typically between $500 to $700 depending on the market. Now, if you get into the jumbo category, big loans, we haven't touched the specifics on that yet, but those can be upwards as $1,200. And some of these price points require 2 appraisals. So you could be on the hook for up to $2,500, $2,400 if your loan size from your lender's perspective requires 2 appraisals. So it's important to understand that that is a real thing that could happen. Title and escrow fees, title search between $200 and $500. Then you've got your title insurance. Let's say on a $500,000 property, that might be around $3,000, $3,800, somewhere around there. That is a policy that does not protect you as a first-time home buyer. It's for the lender only, but there's no way around it. Every lender on the planet requires title insurance. It protects them, not you, but you have to have it. Now, the owner's title insurance is a lot less expensive and it's optional, but I would highly recommend it. That protects your ownership rights in the property for the life of the time you own it. So for example, somebody comes back and claims some sort of weird title, this or that. Hey, I had this section of your property that I owned. The title insurance will protect you. They will fight on your behalf, cover legal fees, etc., to clean up any of those messes and protect your ownership. A lot of places also have an escrow or a closing fee. It can be $500 to $1,000. Some places also charge a remote notary fee. I would steer away from people that do that. Those should be captured inside of the total cost that they're charging you for their service. If you're working with a title company that doesn't allow remote work, remote notaries, online closings, the 2026 and beyond way of doing business, I would run for the hills. They are old and archaic and are going to get left behind. Those are things that are very common today. They're very efficient and they make the buying process so much smoother. Next up, we have our prepaid items. These are taxes and insurance and prepaid interest. Typically, your prepaid items like taxes will have to collect between 2 and 6 months prepaid, depending on when. Also, your insurance, you have to pay your first year up front, and then you have to escrow if you're escrowing these items another 2 to 3 months set aside. And then lastly, your prepaid interest. From the day of closing to the end of the month, you always have to prepay interest. That's how mortgages work. So if you close in the beginning of the month, your prepaid interest will go way up because you're prepaying for the rest of the month. If you close at the end of the month, your prepaid interest will go down because there's no more days left in the month. Now, one thing people like to talk about is, well, I want to skip 2 payments. So if I close on February the 1st, then I skip February, I skip March, I won't make my first payment till April. And in theory, that's correct. But what they don't like to say is you're prepaying the interest for the entire month of February. So you're still paying that money. You're paying it at closing rather than in the form of a payment. So there's not really a big savings. It's just kind of some hand waving done by sneaky lenders. So there's no wrong answer. Do what's best for you, but just want to make sure you're aware of the differences. Other fees out there, home inspections, those are typically, I would say, between $400 to $1,200. It just depends on the level of service you get and the market you're in. A lot of times your real estate agents can make good recommendations for home inspectors they trust. Surveys, some states require them, some states don't. Typically around $500 to get a good survey. Recording fees, $100, $200. Attorney's fees, it varies by state. Every state is different on if it's required or not. Obviously, if you have an attorney fee, there'll be extra fees to cover that cost. All right, here's a pro tip for you. Closing costs are negotiable. You can ask the seller to pay some or all of them, especially if you're in a buyer's market. You can also shop around for some of these things and try to get the best deal. I recommend trying to find one group that can offer everything with one tight network. They typically will have it really dialed in with the best combination of service and cost. The cheapest is not always the best, as you guys know. You're literally about to buy the most expensive thing you've probably ever purchased. You don't want to go to aisle 5 to get your mortgage, your insurance, and your title. It's really important that you find people you can trust at fair cost. All right, let's talk more about earnest money deposits. When you make an offer, you will put down the earnest money deposit. Think of it as a good faith deposit. It shows that you're serious about the purchase, and it's part of the negotiation to figure out how much that is going to be. Like I said before, there are some areas that don't have this as part of their normal contract culture, but most areas is between 1% to 3%. Now, this money is paid by the buyer and it's held by the title company or the real estate broker. It's not too common for the real estate broker to hold it anymore. That used to be the way. Now it's typically held by a title company. Really important to get very, very specific with the instructions of how to send that money. We'll talk a little bit later about fraud, but this is the number one place that people screw up is their earnest money deposits and wiring the final funds. Those are where the fraudsters are trying to attack us. So you have to be very cautious. So you're basically going to get credited this earnest money deposit towards your down payment or your closing costs at closing. So for example, let's say your closing costs are $15,000 and you put a $5,000 earnest money deposit. When you get to closing, you only have 10 left to pay. Simple math. It's important that you understand what this figure is covering. It is your skin in the game. So if you breach in your contract, you are at risk of losing this. If you back out for any reason not covered by your contingencies, you're at risk for losing this earnest money deposit. So you have to make sure that you're doing your part in the contract to where your contingencies are solid. Use your agent to keep everything in line to make sure that you don't fall out of any of these option periods and you're doing things right to where your earnest money deposit is not a risk. So your offer got accepted. Congratulations. We've done a lot to get to this point. Now you're under contract or in contract, as some places say it. This is where deals go to die or survive. So getting your offer accepted, you feel like you're winning, but the game isn't over. You have the next 30 to 45 days, depending on your contract. It could be 10, depending on your contract and the location, where everything comes together or dies. It's really important that this is where you heavily lean on your team to make sure that you're staying in compliance and make sure, like I said, you're not doing things like risking your earnest money deposit. We talked about home inspections. It's a really, really smart idea to get a home inspection at this stage right after you go in contract. Some places that are aggressive do like walk-in talks. They'll get pre-inspections before you even write your offer, because sometimes, remember, these inspections are waived. or just for informational purposes and you can't negotiate. Hopefully you're buying in a market that is balanced and you're able to use this home inspection to get things fixed. You can negotiate different types of repairs for serious things that are going on with the house. You always want to be somewhat reasonable and use the judgment of your agent. They'll be able to kind of measure the cadence of the deal and what's going on in the market to see what's a fair way to negotiate these items. But you'll make your list of items that need to be fixed and you'll get them repaired. At the same time, your loan is in process with your lender and they're going to order your appraisal. And this is important because if the appraisal doesn't come in at the purchase price, everyone seems to think this is a bad thing for buyers. If you have an appraisal protection clause in your contract, the best news ever is if the appraisal doesn't come in. Why? If I offered you $500,000 and I was willing to pay $500,000, but the appraisal says it's only worth $470,000, I now, with the seller's approval, get to pay $470,000. I just saved $30,000. That would excite me. I don't know about you guys, but appraisal being low, as long as you have the proper expectation and you're willing to walk away from the house, can be a really nice thing. So if it does come in low, what we end up doing is we end up adjusting the contract with everyone's permission because the lender cannot loan anything beyond the appraised value. Everything gets adjusted based on that new low number. Now, if it comes in high, nothing changes. You walked into some equity. That means you have an amazing real estate agent. Those things happen and they're a lot of fun too. You've got your appraisal back. You've cleared all of that. You're going to go through and have a processor typically attached to your loan, and they are going to help clear all of the conditions that are attached to your loan approval. So you receive the first approval, then you've got all these conditions attached to that approval. The processor will one by one chip away at all of those items, and they're looking to get you what's called clear to close. Everyone's favorite 3 words, otherwise known as CTC. That's what we're hoping for. You want to get it as fast as possible because typically what that means with most lenders is they stop asking questions from the underwriter. A lot of times you can get the clear to close, I would say in most places in 2 to 3 weeks from the time you submit your loan. Some lenders pride themselves on being really fast, which is a great benefit, especially when you're stressed out as a first-time home buyer. Try to find a lender that can do this a lot faster. I know we can do clear to closes in as fast as 7 days, 4 days, 2 weeks. Those are all comfortable numbers and gives you a nice cadence because what you want is to be done with that part of the process. You want to be worried about paint colors, not about conditions on a loan and talking to your lender, honestly. Inside of all of that, there's the title search that is done. You can't get your clear to close without the title search. It's done by the title company. They should be working in tandem with your lender and also your title insurance. Now, a couple things to remember in this process. You should not be doing anything out of the ordinary. Don't change jobs, don't get married, don't get divorced, don't buy a car, don't buy a yacht, don't buy a plane. No new trade lines, no new Best Buy cards, no interest, deferred interest for the next 2 years buying furniture. Just be normal and everything will be fine. If you have a question or you think you should ask a question, don't be shy. Reach out to your lender and ask them. They will help you. It is their job to guide you. So after all of that is done, you haven't bought a yacht. So therefore your debt to income ratio has not changed. You've got the clear to close. Everything has been cleared by everybody. You are going to go to the final walkthrough with your agent. They are going to verify that the house is still standing in the exact same condition as it was the last time you saw it. It's important to have these walkthroughs because I've seen stories where pipe have burst in a freeze and they actually went to the house the day before the closing. There was no issues. The morning of, a pipe burst and the house flooded. So you want your walkthrough to be as close as practical to the closing date and time to where there are no issues like that. If you're in crazy extreme conditions, you definitely have to go and check that house before you take ownership to protect yourself. After your final walkthrough, you typically go to your closing that same day, sometimes the next day. There's lots of ways now to close and sign your final paperwork. Most smart lenders will do something called a hybrid closing where you sign your lender docs in the morning And those are the most important part of the documents because that's where all the money is attached to. If you do those separately without being in front of the rest of the crowd, the title company, etc., it's a lot smoother. You can ask a lot of questions, just dedicated time for you. So I really like that part of the process. Then when you get to the closing table, all you do is sign a few documents. You can be in and out of there in 20 minutes. It's super fast. Now, if you do the entire closing at the table, it could take you hours. Just be mindful of that. Try to find a lender that pre-funds and pre-authorizes. What that means is that you wire the money to the title company the morning of the closing, not after docs are signed. The reason you do that is if I wire the money to the title company the morning of, once you sign the last document, you are out of there with your keys. You're not waiting on anything because everything has been pre-authorized and pre-funded. So when you're done, you're really done. Everyone gets paid. Everybody's happy. If you don't have this, you will wait for the title company to scan every single document, send it back to the lender digitally. The closing department has to review every page, make sure it's perfectly signed before they then authorize the funding. That could take you hours of dreadful time. But I need to warn you of something that's real: wire fraud. I've seen this cost people hundreds of thousands of dollars. It is at an all-time high right now. Here's what they're doing. They're actually going into your email inbox and they hack inside of there. They're monitoring real estate email accounts. They're sending fake wire instructions that look legitimate. Buyers are wiring their down payments to these criminals. Once it's gone forever. You should never entrust wire instructions sent via email alone. Always call whoever the recipient is, the title company typically, and directly speak to someone that you looked up yourself, not from an email. The email is the problem. When you talk to them, manually verify the wire instructions verbally before sending any money. And be very suspicious of any last minute changes to wire instructions. If you get an email saying the wire instructions have changed, that's a massive red flag. Stop everything and call your title company directly, not from the new email. Really big deal. Remember, real estate agents' email addresses are the ones that have been hacked more than anybody else. They are being targeted. So you have to be really cautious. All right, it's closing day. You have done the walkthrough. Everything has been wonderful because you followed step by step everything on this video. I explained to you guys exactly the best way to sign and to get your keys, so you can confidently ask those questions about hybrid closings and save yourself a lot of time. At the closing, be sure to bring an ID and your certified check or your wire confirmation if you ended up wiring. A lot of title companies now have an app that will connect directly to your bank account. That's probably my favorite way to send funds, or just the old school certified check. Now, who will be there? The title company obviously will always be there. Sometimes a lender's representative will be there. If you did the hybrid closing, you did their part in the morning, there's no need for them to show up again at closing because they've already done it with you. And then typically your real estate agent. They don't always come, but I know a lot of agents like to be there. If any one of your team are not there, just be really sure that you've had a conversation with them about what to expect the day before. Don't be nervous that they're not there. There's really very little that changes at the closing table. It's very rare that you see something come up, but you should do your due diligence. Ask each professional on your team if they've reviewed your final documents and that if they're comfortable with the way everything looks. Puts the onus back on them to dive in there and make sure that they've done their homework. Now, if you're working with a lender that has a team, they typically will have a dedicated person that is going through that final step with you and going over that CD to make sure it's nice and perfect. And it's exactly what you've expected. You'll have seen it a few times, so you should be very familiar with what it looks like. And that way on signing day, there's really not a lot to think about. You've signed your final closing disclosure. You reviewed the numbers. They cannot change, so make sure you're very comfortable with them. And now you actually get your keys. It's really been an incredible process. But don't forget to figure out when your first payment due for your mortgage. Don't run out of there with your keys. Ask the question, hey, when is my first payment due? Also, be sure to understand that some lenders will sell the servicing rights to your loan. You didn't do anything wrong. They're not parting ways with you because they don't like you. It's just part of the business. Loans are sold, thousands of them at a time, to different service companies. That's just the way the market works. No big deal. Just be sure you get something in the mail and then reach out to your current servicer to validate that there is a new servicer taking over your loan so you know where to send future payments. So you're the homeowner, but now what? Congratulations, you just bought your first home. Take a moment to celebrate. But here's a few quick things to handle in your first week or two as a homeowner. First off, change your locks. It's a really good idea to get that done right away. Setting up utilities is also another really important one. Hopefully you've done that in advance, not after closing. Some places will give you a little bit of grace period, but something like a gas utility, you have to do that weeks in advance. So hopefully you've already done all of that and your agent has given you a checklist. Saving important documents, highly recommend when you leave that closing to ask the title company to send all of your documents in email format or through their portal. Make sure you separately get a copy of your closing disclosure or ALTA. That's going to be what you use to file your taxes. You want to have that at the end of every year so you can write off the interest for your mortgage. Starting an emergency fund is also a really good idea. If you didn't buy a home warranty, you should really have some money set aside because houses will break. It's just a matter of time. I would highly recommend have some funds set aside to cover certain home repairs based on the ages of some of the systems for the houses you bought. Also, check your warranties. If you've got new items that have been installed in the house and they haven't been registered, lots of times these companies like HVAC companies will actually give you an extra 1-year extension if you go and register your warranty. It's a really good idea. You can get another year or longer depending on the item, but you want to check to make sure you have an understanding of if those items are still in warranty before you replace it. You did it. You went from wondering if you could ever afford a house to actually owning one. That's a huge accomplishment. Congratulations and welcome to homeownership.